Hello and welcome to our RegAdvisor briefing, where we will recap the regulatory activity from the third quarter of 2024. It's very hard to believe that it is already October 15th. I'm going to give people just a minute to come in and then we will get started. All right, for those of you who have previously joined us, the agenda is the same. I'm Lori Peterson, Senior Regulatory Compliance Expert here at Mitratech Continuity. As always, we will record this session. It will be posted in our support center and included in this reg control if you wish to distribute the session throughout your organization and track whether it has been reviewed. If you have any questions, clients, please use your normal channels. Welcome to our guests. If guests have any questions, you may either submit them in the chat box during the webinar, or you may reach out to your sales representative. Here are other Mitratech solutions that might be of interest to your institution. If you'd like to learn more, please contact your account manager or sales representative. In addition to our RegAdvisor alerts and these briefings, here are the other ways that we provide regulatory change information to you. Our RegFacts videos are recorded monthly and are posted on Mitratech's public site and in the Continuity Support Center. Our client-only newsletter is also available in the Support Center. We'd like to know which methods you prefer to use to receive this information, so please answer our first poll question. I'll give you a minute to answer those. All right, thank you for your answers. All right, I see that all of the above and RegAdvisor alerts are our biggest winners. All right, thank you for that information. All right, here's our Regulatory Operations Center's data for the third quarter, in which we received 85 issuances comprised of more than 1,700 pages. For the year, we've received one or more issuances each calendar day. We've read them all. But the good news for you is that with our compression rate of 90%, you only need to read 10% of these thousands of pages. In the enforcement actions area, we issued 40 alerts. 3 of those involved individuals, and nearly $400 million in penalties were assessed. The regulators continue to be very active in the enforcement action area. For the quarter, we also issued 161 state RegAdvisor alerts. If you are interested in our enforcement action or state products, please contact your account manager or your sales representative. We'll move into the meat of our discussion here, starting with ACH. We've had more activity than usual in the third quarter, with NACHA issuing 2 operations bulletins and publishing 1 blog. Operations Bulletin 1 extended the effective date for an RDFI to optionally comply with an ODFI's request for the return of any entry. The new effective date is April 1st, 2025. And note that regardless of whether the RDFI complies with the request, the RDFI must advise the ODFI of its decision or the status of the request within 10 banking days of receipt. Operations Bulletin 2 encourages RDFIs to voluntarily adopt the individual name field in consumer ACH entries. NACHA believes that implementing standardization will support automated and manual review of a suspicious entry. It will permit RDFIs to better identify when an account is receiving entries for multiple receivers who might not be named on the account. It will also allow parties to review entries more easily and improve name recognition. It supports an RDFI's reconciliation of the name in the entry against the name of the account owner, and then overall just improves the integrity of the ACH system. NACHA recommended specific name field standards within this bulletin, which became effective July 22nd, 2024. Lastly, NACHA published a blog recommending that RDFIs that enter into a relationship with a fintech provider have a documented process for onboarding those providers, and that RDFIs consider the fintech's role in ACH transactions and the risks that could impact customer access to funds. And finally, that the RDFI assess what obligations they may have if the fintech fails to provide that access. There are also recommendations for establishing agreements with fintech providers. Moving on to the BSA area, we had 4 final rules. In June, OFAC amended its Syrian sanctions regulations, added 1 new FAQ, and revised 5 existing FAQs. The rule became effective June 6th when it was published in the Federal Register, and the FAQs were effective on June 5th. In July, FinCEN issued a special measure final rule to prohibit U.S. financial institutions from opening or maintaining accounts with Alhuda Bank. It requires U.S. institutions to take steps not to process foreign correspondent transactions in the U.S. if Alhuda Bank is involved. It also requires institutions to conduct special due diligence for foreign correspondent accounts. This rule became effective August 2nd. In July, OFAC issued a new reporting requirement for institutions that are holding Russian sovereign assets. This rule became effective on July 26th with a mandatory compliance date of August 2nd. In September, OFAC issued a rule increasing the record-keeping requirements for certain transactions from 5 to 10 years. While this rule is scheduled to become effective March 12th of next year, OFAC was also accepting comments until today, October 15th. When reviewing this alert, please consider the impact it will have on your physical and electronic record keeping, and advise your senior management and the board of any additional resources you may need to comply. We had 2 proposed rules that are related. In July, FinCEN proposed to amend the BSA regulations to implement the 2020 Anti-Money Laundering Act to add 2 new pillars. BSA AML programs would now be known as AML CFT programs and would be required to include a risk assessment that would be required to consider AML CFT national priorities. Of course, it would include internal policies, procedures, and controls as the current BSA AML programs do. You'd be required to have 1 or more qualified individuals to coordinate and monitor day-to-day compliance responsibilities, training, and periodic independent testing, as always. And they would implement risk-based procedures for ongoing due diligence. Comments were due on that September 3rd. The second proposal was from the agencies, and they were really just proposing to implement the FinCEN regulations. So those were really mimicking each other. The comments were due on that October 8th. In the BSA area, we received several items that required action or info alerts. First, in June, FinCEN issued a statement regarding changes in the Financial Action Task Force list. The statement highlighted the financial connection between North Korea and the international financial system. It also restated concerns over North Korea's failure to address significant AML deficiencies and the threat the country poses by financing weapons of mass destruction. In July, OFAC issued standards for persons providing responses to administrative subpoenas, requests for information, and voluntary self-disclosures. In July, FinCEN once again updated the beneficial ownership information FAQs. None of these affected financial institutions. Also in July, FinCEN issued an additional alert regarding Israeli extremist violence in the West Bank and advised financial institutions of additional red flags to assist you in identifying and reporting suspicious activity that finances this violent behavior. In conjunction with the proposed rule, FinCEN and the other agencies issued an interagency statement to highlight their implementation efforts related to the AML Act. FinCEN and OFAC jointly issued a notice regarding Mexico-based transnational criminal organizations who target U.S. owners of high-end and rarely used timeshare properties in Mexico. They target older adults and they perpetrate telemarketing scams by offering to purchase or rent their timeshares at or above market rates and convincing the owners that they are entitled to shares of stock of their timeshares and then offering to broker sales of that stock. The victims are provided official looking documents and then they're pressured into paying fake taxes or fees to expedite the transaction. These funds will supposedly be held in escrow until the transaction is complete, but of course, these transactions are never completed and the funds have been stolen. I would encourage you to review the 10 red flags highlighted in this alert and ensure that your staff are familiar with this type of fraud so that they can assist your customers and members to help them avoid becoming victims. OFAC issued guidance regarding the statute of limitations for sanctions violation. Generally, OFAC may now begin an enforcement action for certain civil violations within 10 years of the latest date of the violation, if that violation occurred on or after April 24th, 2019, and was not time barred. Again, in July, FinCEN updated its beneficial ownership information FAQs. These also did not affect financial institutions. FinCEN issued a notice to customers of financial institutions regarding BOI requirements. We wanted you to be aware of this notice in case your customers or members request your assistance. OFAC updated FAQs to ensure that their published guidance remains current. They did that regarding basic information on OFAC and sanctions, and then also with regard to their Cuban sanctions program. In September, OFAC issued an alert concerning Russian attempts to evade sanctions using overseas branches and subsidiaries. They also amended one related FAQ. And then again in September, FinCEN updated the BOI FAQs. And again, these did not impact financial institutions. They seem to be updating these FAQs almost monthly now. For our RegControls subscribers, here are the RegControls that can assist you in complying with these issuances. In addition, we updated our policy templates for banks and credit unions to reflect changes in OFAC's reporting procedures and penalties. I wanted to point out that we have RegControls and a Support Center article regarding senior citizen financial abuse that might help you if you run into any situations that have to do with the Mexican timeshare fraud that we discussed a moment ago. Moving to the CRA area, there were no final or proposed rules. Remember that the final CRA rule still is not in effect as the lawsuit is ongoing. In July, the agencies issued the 2024 list of distressed or underserved non-metropolitan middle-income geographies. Your revitalization or stabilization activities in these areas are eligible for community development consideration for 12 months after publication of this list. Here are the RegControls that can help you demonstrate that your efforts are eligible for CRA credit. In the compliance area, we had one rule issued. We went over this last quarter, but given the impact this will have on your operations, I wanted to include the small business lending data collection rule in this presentation as well. As we discussed in last quarter's presentation, the U.S. Supreme Court ruled that the CFPB's funding is constitutional. As a result, the CFPB adjusted the mandatory compliance and reporting dates to match the number of days the rule was stayed, and that's why we have these very strange-looking mandatory collection and compliance dates. Due to the length of time since we published the original alert in 2023, we elected to republish our entire alert, updated, of course, as needed. so that you would not have to cross-reference these two alerts. So you have one alert that you can focus on. As you can see, Tier 1 lenders are required to begin collecting data on July 18th of 2025, Tier 2 on January 16th, 2026, and Tier 3 on October 18th of 2026. In each case, initial reporting is required on June 1st of the year following when data collection begins. And the CFPB does permit you to begin collecting protected demographic information 12 months prior to your applicable compliance date. However, you would also be required to comply with all data collection, firewall, and record keeping requirements at this time. So you should carefully select your implementation date and make sure that you've got your program in place. Well, here is our second poll. We'd like to get an idea of how many clients of ours fall into which tiers for this lending rule, or whether you are not subject to the rule, or whether you really don't know where you are and you might need some assistance. So if you'll go ahead and answer that, we would appreciate it. Give that a minute. Thank you for your answers. I see the majority of you are in Tier 2, very few in Tier 1, and then some in Tier 3, and some not subject to the rule. I'm a bit surprised by that, and some unknown. Thank you for those answers. Here are two existing reg controls that can help you right now with this rule. The first helps you determine whether a particular loan is covered under the small business lending rule. If you don't already have this information readily available to you, we suggest that you use this reg control so that you can compile it and help determine your status as a reporter. The second reg control helps you determine the institution status and mandatory compliance date. In addition to these reg controls, we plan to develop a complete suite of reg controls to help you comply with this rule. And these will be similar to what our HMDA reporter clients are already using. There were 4 proposed rules in the third quarter. The CFPB issued 3 of them. The first proposed rule would amend Regulation V to remove the exception that allows institutions to consider medical, financial, and debt information. It would also prohibit consumer reporting agencies from furnishing a consumer report that contains medical debt information. The comments were due on this August 12th, and I did read recently that the CFPB is close to finalizing this rule, and of course we will be issuing an alert for you after that is published in the Federal Register. The second proposal concerned earned wage products. In this case, the CFPB issued a proposed interpretive rule that would help creditors determine when Reg Z requirements are triggered. Comments were due on that proposal August 30th. The CFPB also proposed to streamline mortgage servicing requirements regarding loss mitigation and foreclosure procedures, and they would remove most of the existing requirements concerning incomplete and complete loss mitigation applications and replace those with a more flexible framework. The CFPB believes that this proposal could avoid unnecessary costs associated with foreclosures, and the comments were due on that September 9th. The FCC proposed to amend the Telephone Consumer Protection Act to protect consumers from AI-generated robocalls and robotexts, and I think we would all be grateful for that. But also to provide for positive uses of AI for disabled persons. The comments were due on that October 10th. In other items, the FDIC received many questions, as have we, regarding its official sign and advertising requirements rules and has published Q&As and hosted webinars as a result. I believe another webinar is being hosted tomorrow. This rule was technically effective April 1st of this year with a quote unquote compliance date of January 1st of next year. Typically, the regulators use the term mandatory compliance date, meaning that you can begin complying April 1st, but you must comply by January 1st. This ruling was not as clearly stated as maybe it could have been. And so they have since clarified in both the webinars and in the Q&As that compliance is not required until January 1st. But the FDIC has also heard from many bankers that January 1st does not provide sufficient time to make the required changes. So the FDIC board is considering an extension at its October 17th meeting. If that extension is approved, we will publish an alert after it publishes in the Federal Register. The bank agencies issued a statement regarding risks and successful risk management practices for banks to engage with third parties to deliver bank deposit products and services. And this continues the regulator's trend of providing guidance on third-party relationships. We've had quite a few of these issuances over the last year. This guidance discussed the operational compliance and growth risks associated with these arrangements, as well as the potential for end user confusion and violations concerning misrepresentation of deposit insurance coverage, which we have certainly seen in the enforcement action area. The agencies issued guidance regarding reconsiderations of value and how financial institutions may choose to implement ROV processes and controls. The guidance includes potential risks related to deficient collateral valuations, including, of course, the harm to consumers. The guidance includes the relevant laws and regulations related to lending discrimination and appraisal requirements, and those have not changed. It also includes examples of policies, procedures, and control systems that you might wish to adopt. Again, this is optional, but if you don't already have an ROV process in place, I recommend reviewing this list and to determine whether you will adopt any of these or whether you want to develop your own process. If you already have an ROV process, I recommend reviewing the examples to see if there might be some room for improvement in your existing program. As a result of the ROV issuance, we updated our complaint and appraisal reg controls. Here are a few examples. Within the complaint reg controls, you can now track whether a residential mortgage loan complaint involves an appraisal, and if so, whether appraisal bias or discrimination is alleged. In our appraisal reg controls, we now include questions regarding ROV processes, and this is in addition to our existing questions concerning potential discriminatory practices. In August, the FDIC issued 16 new Q&As regarding the advertising rules. Currently, there are 39 Q&As on the FDIC's website. The CFPB updated the Small Business Lending Data Collection Filing Instructions Guide to reflect the new compliance dates we discussed earlier. And they also announced that the beta platform is available for lenders to upload, test, and validate small business lending data. That data is only for testing purposes, and it might be deleted at any time. The CFPB issued an advisory opinion regarding contracts for deed to specify that those transactions are subject to Reg Z disclosure requirements if the transaction is subject to a finance charge and is payable by a written agreement in more than 4 payments, not including the down payment, if the loan is initially payable to a natural person or organization, and that is evidenced by the agreement, and then also if the seller is a creditor because it meets the lending thresholds of Regulation Z. The CFPB issued 12 FAQs to clarify the buy now, pay later interpretive rule that became effective July 30th of this year. The FAQs generally reiterated the interpretive rule, but importantly, it included 2 new FAQs regarding what sections of Regulation Z are applicable to buy now, pay later loan products and what information must be included on periodic statements. In our alert, we specifically pointed out these two FAQs since the CFPB had not previously provided that information and it was very much needed. Here are the RegControls and Support Center articles related to the CFPB lending rule and the other CFPB issuances, the FDIC advertising rule, and the interagency guidance on ROVs. These articles, policy templates, and reg controls were reviewed and updated as needed. Moving into the IT area, we had no final rules and one proposed rule. The banking agencies issued a request for information and comment regarding bank fintech relationships, including the nature, benefits, and risks of those relationships, effective risk management practices, and whether they should enhance existing supervisory guidance to help address those risks. The request focused on deposit-taking agreements, payment arrangements, consumer and small business lending arrangements, and also discussed the role of intermediate platform providers. The comments are now due on this October 30th. The FFIEC issued an IT development, acquisition, and maintenance booklet to help examiners assess an institution's IT practices and to help institutions maintain compliance and prepare for exams. This is part of the FFIEC's Technology Exam Handbook. The FFIEC also announced that it will retire the cybersecurity assessment tool effective August 31st, 2025, since there are several new and updated government and industry resources available to you to better manage your institution's cybersecurity risk. The issuance included a list of those available resources. In the safety and soundness area, we had two final rules. The first from the FDIC requires banks with assets of at least $50 billion, but less than $100 billion to submit informational filings. This rule became effective October 1st. The FDIC's regulation implementing the Fair Hiring and Banking Act also became effective on October 1st. It relaxes the standards so that individuals with certain older offenses or offenses that were committed when they were 21 or younger may be hired by an FDIC-insured bank without an application if certain criteria are met. And this could expand your hiring pool and avoid the FDIC application process. We are currently processing the NCUA's regulation to implement the Fair Hiring and Banking Act. That rule is effective October 30th, and we expect to issue the alert this week. We had two proposed rules in the safety and soundness area. The first is the NCUA's proposal concerning succession planning that would require federally insured credit unions, both federal and state, to establish and adhere to a succession plan. Comments were due on that September 23rd. The FDIC proposed to expand coverage of its regulations that concern industrial banks to those that become a subsidiary of a company that is not subject to the Federal Reserve's supervision. Comments were due October 11th. The FDIC issued call report instructions for the June 30th report. The FCA issued guidance regarding capital treatment for rural water and wastewater facilities. The FDIC issued an update to the loans portion of its risk management manual of examination policies. And as always, revisions to manuals do not change existing requirements or impose new ones. The FCA issued revised guidance on sound investment management practices, and the NCUA updated the simplified CECL tool for September 30th. In our final area, we have 6 final rules. The CFPB finalized its rules requiring non-banks that are subject to final orders from an agency or court order to register with the CFPB. I've heard this rule referred to as the name and blame rule, since the public will be able to more easily access information about enforcement actions involving non-banks. This became effective September 16th. The FDIC issued an interim final rule to clarify that it insures deposits of U.S. banks operating in the federal states of Micronesia, the Republic of the Marshall Islands, and the Republic of Palau. This rule became effective August 9th, but the FDIC accepted comments until October 8th. The FTC issued a final rule that prohibits certain unfair, deceptive acts or practices involving consumer reviews or testimonials, including selling or purchasing fake consumer reviews or testimonials, buying positive or negative consumer reviews, creating consumer reviews or testimonials involving officers and managers of the institution or entity without clearly disclosing those relationships. Suppressing reviews is also prohibited, as is selling or purchasing fake indicators of social media influence. This rule becomes effective October 21st, and we will be updating our advertising reg controls to reflect these requirements. The FTC also slightly increased fees that they charge to access the Do Not Call registry. This became effective October 1st, and this is an annual update that they make. Here are the Reg Controls and Support Center articles that we are revising to reflect the provisions in this new rule concerning consumer reviews and testimonials. Regulations A and D were updated to reflect the 0.5% decrease in the Fed funds rate. Now the rate for primary credit at a Federal Reserve Bank is at 5%. Secondary credit is 5.5%, and interest on reserve balances is at 4.9%. Those were both effective September 25th. There were 4 proposed rules in this area. First, the bank agencies requested comments under the Economic Growth and Regulatory Paperwork Reduction Act, otherwise known as EGRIPRA, which requires that agencies periodically review their regulations to identify outdated or unnecessary regulatory requirements. And I'm sure you can all think of a few. In this second round, the regulators requested comment on rules concerning consumer protection, directors, officers, and employees, and money laundering. Comments are due on that October 30th. The FDIC requested comment on deposit data that is not currently reported on the call report. They are particularly interested in receiving data on uninsured deposits in light of last year's bank failures. Comments were due October 7th. The FDIC is proposing to remove an exemption from the Change in Bank Control Act's notification requirements so that it would retain the option to review a notice concerning the purchase of securities of a holding company that owns an FDIC-insured institution, even though the Federal Reserve would also be reviewing that holding company application. Comments are due on that October 18th. The agencies are proposing to establish standards that financial institutions would use to collect and submit data to the regulators. Comments are due on that October 21st. In July, the NCUA extended the deadline for the 2024 Community Development Revolving Loan Fund to July 12th. The CFPB issued a circular advising financial institutions that requiring employees to sign overly broad confidentiality agreements may violate the whistleblower protections under the Consumer Financial Protection Act. The law specifically states that whistleblower employees may not be discriminated against, and that would include suing or taking adverse action against those employees or threatening to take action for engaging in whistleblowing activities. The circular states that agreements that protect confidential trade secrets or safeguard sensitive personal information are legitimate, but that broadly worded agreements that might forbid or dissuade employees from reporting suspected violations or cooperating with a government investigation may violate the Consumer Financial Protection Act. This was effective when it was announced on July 24th. We recommend that you review your employment agreements and discuss with your legal counsel whether any changes are needed. In August, the FDIC clarified that using an interactive teller machine at a location other than an established branch facility does not require a branch application if the machine is automated and unstaffed, if it's operated exclusively for the bank, and if it allows customers to initiate interactive sessions with remotely located bank staff, as long as customers are able to perform basic functions on their own. The OCC also updated its bank advisory series. There are no new questions and no substantive updates to existing questions. The NCUA extended the 18% interest rate ceiling for loans made by federal credit unions through March 10th of 2026. And then sadly, the FDIC has had to issue more financial institution letters encouraging financial institutions to work with borrowers and providing institutions with additional guidance on facilitating recovery in affected areas of many states throughout the country. Here is a list of those FDIC alerts. We hope that you and your communities are recovering from these storms and wildfires and from the most recent hurricane and wildfire events. Thank you for joining me. I hope you have a pleasant day, and we will see you again in January.